So here, as we pivot to segment 2, we want to look at, what happened with GDP. So GDP price index snapped back in the third quarter to 3.5% quarterly versus the 2.7% estimated. Q2 gross private domestic investment came in at 8.4%, which was the strongest gain since Q4 of 21. And these are going to be important pieces because when you look at price index, that's not exactly a strong place to be when you look at that reacceleration of inflation, the problems that we continue to see, but you still have private domestic investment and the domestic side, especially on the consumer front, much better than what the expectations were. So we want to look at, was this the last spending component? And that's when we want to break it into its pieces. So consumer spending in Q3 came in at 4%, which is 68.9% of GDP. So you can see there was obviously a massive bump. And as we've been talking about, there was that slowdown as you saw in Q2, but you still had, there was still spending. When you look at credit card balances, when you look at activity, things have been going up. You had July, which was a very good month. August was a bit weaker, but July was a big carry through. And that's an important piece when you look at how this really kind of set things up. As we went into July, you had a pretty good back to school. So now when you look at a lot of the spending side, you saw that reacceleration of prices and that reacceleration of inflation. So what we do see is that Q4 is going to be slower. It's not going to be negative at this point. It's just going to be much slower. Federal spending ticked up, which is not surprising when you look at some of the government spending. That's going to be there consistently when you look at the Inflation Reduction Bill, when you look at some of the spending pieces. And this is also a key component of what the Fed is fighting. The Fed is fighting fiscal spending. Fiscally speaking, we're running a steep deficit. And if you're running the deficit, it means that you're pulling the money out of thin air or, from other people and then deploying it into the market, which is inflationary. So when you look at the restrictive policy, that's where the Fed is struggling because you have to pull back on monetary, but you also have to pull back on fiscal. The problem is, politically speaking, that is usually not something that people enjoy. And this is one of the key pieces that is missed when you look at some of the Democratic liberal views. When you give someone $1, it's very difficult to take that dollar away because they get used to it. If you were to come in like the PPP, and not to say that it wasn't abused, but you come in real quick, you give that money, then it's gone, the program's over, it served its purpose. It's, hit it, and then you're pulling back out, and now you're just gonna let this settle, let this work through the system. When you continue with these broadening safety nets and the amount, and not to say that you shouldn't have safety nets in tough periods, but you have to be willing to take them away in good periods, because now when we're coming through and coming into a very difficult period, it's hard for them to increase spending. Well, what are you going to increase spending to? Look at what you're spending now. How do you increase that? And especially when you have rates that are going up, you have inflation. And let's be fair, there's a lot of things that impact rates. And what impact rates is also money flows. How much paper are you trying to sell? So if the Treasury is trying to increase the sale of paper as the buyers of that bond are diminishing, well, you're going to be charged a higher interest rate to borrow the same amount. So again, these are things that are going to have to be addressed. When you look at the net exports and goods and services, fairly fixed. Fixed investment, non-residential remains that struggle point. And then obviously you had that nice bump in that change in private inventories. And remember, inventories is that fluctuation that we always talk about, where it can be very lumpy, but that's something that is a net positive when it's an increase of 1.3%. So when you look at some of the key pieces, the biggest one is going to be that consumer spending, which is why we talk so much about the consumer. So then when you look at the personal consumption increase by 4%, you can see that on a on the percentage side, and on that chained level, that's good. But look at the blue line. So you've seen that it's still a nice little acceleration. The question is, when does that start to roll over? Because when you look at Q3 GDP coming in at 4.9% annualized, the estimates for 4.5, strongest quarter. So it's not that, and you could see that it was moving on that GDP US chained, that yellow bar chart on the bottom right. You can see that the trend was going down. Now you have a nice little spike, but does the trend continue to move down? And if you look at Q4 of 21, you had that nice little spike and then that negative move. Now, we don't see Q4 being better than Q3, but it doesn't mean that it's going to be steeply negative. But it doesn't bode well for Q1 and Q2 when you look at how long does it take for for monetary tightening to get through the system, which we're really starting to see it impact now when you start looking at the way money is moving. Inflation has been reaccelerating in recent months, looking at core services, Atlanta Fed sticky, Cleveland trimmed, Cleveland median CPI. So all of these are showing that acceleration point as we come into September. And unfortunately, when you look at October, you did get some reduction in the flexible inflation, but you actually had another increase in sticky. So when you look at the backdrop in general, there's still a lot of work to be done. So as we said before, we were expecting initially the Fed to increase rates again in November. It's likely going to be delayed because of the geopolitical impacts, but it doesn't mean that there's not going to be something in January or even December, but more likely January, to try to really continue to get in front of this and to see, do we get a bigger slowdown? Because so far the consumer's still spending, and that's still putting that additional money out there. We do see them slowing. We have seen them slow, especially when you go from September into October. But then the question is going to be, how long does that take to pull down some of these increase in prices? The U.S. Financial Conditions Index, tighter financial conditions, but still not as tight as they were in 22. So again, the Fed needs things to tighten. They need things to come down. They need things to slow. The tightening in U.S. financial conditions since the September FOMC meeting is equivalent to some 80 basis points worth of Fed rate hikes. Since the September FOMC has tightened by 80 bips in Fed funds equivalent, a little more than 325 basis point hikes worth since. So when you look at, again, the financial tightening, that also, because it's tightened in the sense where there isn't money available. If it is available, you're charging a higher interest rate. And this is what the Fed wants. The Fed wants prices to go up so people borrow less. And if people borrow less, it means that asset prices have to come down to account for the rise in borrowing charges or interest expense. But again, you can see that there's still that waffling back and forth. So they also need to get in front of, where is inflation now? Where is it going? And also, how do they meaningfully bring things down in the longer term, which they've struggled to do in previous down cycles like the 70s. Leading economic index from the Conference Board has declined for 18 consecutive months, which has only happened in recessions that took place in the 70s and 2009. Leading indicators dropped relative to coincident indicators, both tracked by the Conference Board, continues to look consistent with prior recessions. So again, you're seeing things set up, and the reason why we keep coming back to the 70s is because when you looked at the end of the 70s, there was similar commentary. Oh, the Fed has to ease. Oh, inflation is coming down. We've defeated it. Yay, cut rates. Well, they didn't defeat it. There was a lot of things sloshing around that was ignored, or really, what was the election cycle? And you had rate cuts, and then you had a wage price spiral that then brought in Volcker, bringing rates to over 20%. That is what they want to avoid. And the way you do that is to get to a point and then hold firm. And that's where, again, we differ from the market, is we don't see rate cuts in 2024. That is not something that is on the level. Maybe as we get towards the end, there's a quarter point. We don't think so, but these are things that obviously we have the right to change our mind. It's just, when you look at the current backdrop, when you look at labor, inflation, you look at the global markets, there is no impetus at this point to cut rates given where we sit. What is the impact of each of the following risks to the on the industry? This is the CEO side. Cybersecurity is obviously a big problem. We've seen that become a much bigger issue, which isn't a surprise. Legal and regulatory uncertainty, it's still an issue. But the biggest thing is when you look at geopolitical instability, that is something that we expect to move a bit higher, and it kind of marries pretty closely with financial and economic risks, which are go hand in hand when you look at those fears going forward. And then when you look at the CEO confidence reverse lower and for this quarter, which is worth watching as it's a metric that's helped kick off rolling recessions and subsequently beginning of rolling recovery. So when you look at it, one of the things when you look at all of the data together, we do see this as kind of kicking off that rolling recession. But again, and this is, I think, the way people think of a recession. When everyone hears a recession, they think of, blood on the streets, down 20, 15%. It's just not like that this time. And that's what we keep trying to say, because there's so much money out there, so much liquidity sloshing around, that you're just not going to get that level of despair. It's going to be a recession. There's going to be slowdowns. There's going to be pain points, but not to that level. U.S. Consumer Board leading indicator in GDP continues to diverge. And again, when you're running a $600 billion spending spree from the fiscal side with the fiscal spending spree, that's where we're seeing some of this stuff. And a lot of that was filtered down into the consumer. But as the rates go up, as consumers tighten up, that's going to reduce further. The Conference Board leading indicator still suggesting GDP growth, but soon suggests GDP growth will soon slow sharply. Again, that's what we can believe, especially when you look at the net contributors to leading economic indicators. When you look at across the board, all of it still points to new orders, consumer expectations, interest rates. All of it points to pressure. It's just because it's there, it's a leading indicator. And as we've seen, markets can be irrational longer than you can be solvent. Things can prolong. The consumer has fickled many an economist because of their ability to withstand, withhold, and spend. It's just as things slow and as asset prices come down, we should see that as well fall. And the problem is, it can happen rapidly. And that's what we've seen with the consumer. It's like they're normal, increasing. Oh my God, where'd the consumer go? And we've seen that time and time again. It's hard to nail down, this is where they went. Small businesses now paying 10% interest on short-term loans. Again, that's going to bite into wages, that's going to bite into labor, that's going to bite into employment, which is what the Fed wants. And again, we're moving into a level that is at risk and it's unlikely to change. Small business spend on a large share of revenue on interest than corporations. So small businesses and partnerships spend more when you look at interest. And again, it's just because they're paying higher interest rates. Therefore, more of their money has to go to paying it off. And that's where you'll get that tightness in general. But unfortunately, again, it forces the small guy out. And if you didn't prepare like we did, when you look at at C6, when you look at our portfolio companies, we prepared for a higher rates. We prepared for that pain point, which is why we're still around today. Conference Board U.S. leading diffusion 6 months, was very poor in September, but 6 month breadth picked up a bit. Leading economic index, as we said, has been falling, which is going to pull things down. But now this is the fun point. So M2 fell 3.6% in September. So there is a view that, oh my God, we had a big drop. So it's the 10th straight month of contraction at 3.6%, the longest period of money supply contraction since 1933. But you can't ignore the fact that we went from 3.5% to 25.5%. So we had a massive, rapid expansion of the money supply. It's also the longest period of money supply contraction since 1933. Going back to 1960, we've never had a contraction. So we've continuously just padded it, continued to pad it. Then we had the explosion of padding, starting with QE in 2008 into 2009. So you had a massive inflow. So when you look at it, then the spendable money was contracted 6.8% since last year. But again, it's not a boon for disinflation. You still have over $1 trillion in RRPs. You have money sloshing around in hidden places out there because you papered the town by over 20% growth from 2020 until 2022. So again, you can't look at just this little blip to the downside and say, oh, therefore deflation, therefore slowdown. What about all of the money that got blasted through? Not to mention, this is just looking at the M2 side. This doesn't even include the fiscal stimulus that's coming through and continues to come through, which again is that backdrop for continued reaccelerating inflation. When you look at September retail inventories of 0.9 versus the estimate of 0.2, wholesale inventories came in flat. So again, you're seeing that build of inventory still remain. And that's where you're not getting the same level of spending. And September durable goods orders came in at 4.7% versus the estimate of 1.9. A lot of lumpiness in that, but the issue is, again, the continuous move of additional retail inventories coming into the market. So then when you look at the implied change in the overnight rate, putting all of this together, you've seen that there's now an increase in the chance of a rate hike in January. And that's an interesting piece when you look at some of the expectations of the market, when you look at the broader set in general. U.S. inflation and money supply, the view is that inflation is going to continue to go down, but look at the inflation continue to go, but yet you had a bounce higher. Their monetary policy is obviously not saying it isn't. It is a big part of inflation. It's not the only part. Plus, you've had all of these pressure points that have been ignored and built upon, and then you had this massive blast of additional capacity on the monetary front. So you are going to see very lumpy levels of inflation that is going to stay elevated much longer, which is why the money supply has to stay where, on a restrictive basis. The U.S. yield curve has been rapidly steepening, and this is and now even this is old when you look at where things are, because the yield curve, 10-year minus the 2-year, it's continuing to change as the 10-year and the 30-year continue to move up. That's going to be an additional pressure point. And when you look at the volatility index for bonds, it's reaccelerated. That's the biggest issue when you look at how this is going and how we need to address the shortfalls within the spending side, because major entitlement spending programs continue to go up. You have major healthcare programs, which has only gone up since 2000. When you look at Social Security, you had an inflation adjustment, so the underlying U.S. budget gap doubled in the latest year. So when you look at the deficit in general, we're at 2.02 trillion. The net increase is about 1 trillion. Yet, all of these different pieces, California tax receipts estimated the loss of revenue accounts for more than 57% of the total deficit. Well, you're losing revenue because the economy is not doing well. And even though, again, GDP is one measure, GNP is probably, really is a better measure at this point. Net interest on debt increasing, going to be a much bigger. FDIC bailouts, Medicare, Department of Defense. And everyone's going to always point to the Department of Defense. But when you look at the aggregate of it all, $49 billion for the DOD, but then you had $92 billion for Medicare, $101 billion for the FDIC. Well, not to say that we should get rid of the FDIC, but why were we not managing these banks better? Nobody thought interest rates were going to go up. We're doing all of these stress tests. We're only going to factor interest rates going down like they've never gone up before. And again, this is the ignorance that remains in the market in terms of where rates could possibly go. Treasury bills are above 20% of debt outstanding. That's something that is going to continue to go higher. Household sector is absorbing some because, again, as much as I disagree with where the equity markets are in terms of it should be lower, I don't know. The 2-year at 5.5%. And I think you're going to start to see that movement back into some of these treasury points. Now, it's interesting because when you look at green energy stocks, they've dropped as rates have climbed. And one of the things that we've been talking about is that we have to shake out the grift, the zombie companies, and the way you do that is by raising rates. So the green energy stocks have dropped as rates have climbed because a lot of these were factored in with zero interest rate policies, ZIRP. Our whole view is that you can't be sustainable unless you can live without government subsidies. You can't be sustainable unless you are cash flow positive. Renewable energy ETFs suffer investor exodus, things that are going to continue to be on that problematic standpoint. Now, when we look at the deposits, small domestically chartered commercial banks, large domestically chartered commercial banks, you continue to see some of these benefits in general, and a lot of this is because they've started to increase the rates that they're charging, that they're paying. Gap between the average effective federal funds rate and the interest rate cost of banks' deposits, it's still something that has to be closed. So you still have this closure that has to happen because people are not receiving what they should given where rates are. And a lot of that is because banks are exposed in terms of short duration, long duration, the underlying hedge books. U.S. Treasuries account at the Fed's RRP balance, as you can see, remaining at that 1.1 billion Treasury account. And here's where that balance point that we've continued to talk about with liabilities and capital, other factors draining reserve balances and reserve balances within Federal Reserve banks remaining fairly flat. And we do see some of that pressure going up as banks, especially smaller banks, try to tap into and pull some of that protection from the Fed. So then when you look at the 10-year Treasury yield has surged, that's something that, and this is just looking at 4.84, we've gone to 5%. We do think that we get to about 5.25. And under that, guys, you've seen the consensus in the market increase, where there's the year-over-year consensus forecast has gone up for PC inflation. When you look at the in 2024, continuing to move higher as people look at this in a way, and this is something that the Fed has to get in front of because the expectations is that inflation is going up, not because it's unfounded. You just have to look at the data and see that there is that pressure. We're not getting this drop off. We were assuming that we would have been firmly in stagflation heading towards deflation, and we're not there and likely won't be there for some time. And those are things that we want to go through again in the next segment when we look at some of those key leading indicators.